Thank you. And hello, this is the Cut. My name's Simon Cathro of Cathro and Partners. Today we've got our next guest, Domenic Lo Surdo from Stamford Capital. Dominic's going to talk about the area and space that he operates in, and particularly in the construction finance space. Domenic, how are you?
I'm well, Simon. Thanks for inviting me along.
It's very great that you've found some time to come and speak with us. But the way we run these interviews and podcasts is that we just ask you questions about your background. Do you want to just give us a bit of background on where you came from and what you're doing now with Stamford?
Yeah, sure. So I've got a real estate, finance and funds management background personally. So I worked in banking for 6 or 7 years and then worked in funds management with a group called Gresham Partners for a while, so ANZ into Gresham Partners, and then worked for a mid-size broking finance business called Ashmorgan Winthrop. And so mixed and varied set of experience, I guess, but principally in and around commercial real estate, both on the construction side and on the investment side of things.
Yeah, interesting. And that sort of led you into this idea of setting up Stamford Capital. What was it, about 10 years ago, 12 years ago?
12 years ago, yeah.
Yeah, wow.
We started the business.
So how did that come about? Yourself and Michael are the key owners of the business, and what sort of made you sort of make the move into that space? So 12 years ago, you think about 12 years ago, we're just coming out of the GFC. It's sort of pretty difficult conditions at that time.
Yeah, it was late 2010 when we sort of set the business up. There's a couple of things really. It was funny when we started the business. It was really about getting away from the corporate world, to be honest. I got pretty sick of behaviour in the corporate world and the way corporates were engaging or not really engaging with customers, and we thought there was an opportunity just to do things better. And when we started the business, with a set of principles. So we actually started with a list of things that we wanted to be and what we stood for, which are now called our values. They weren't called values back in those days. And a very simple business plan that was all about servicing the customer better. We didn't have a balance sheet. We didn't have a backer of the business at that time, so we needed to transact. We needed to do deals. And as you rightly say, it was coming out of the GFC. It was a difficult time. There was definite lack of capital in markets, and so it was really challenging. But we were very fortunate. I had a relationship with a capital partner out of Singapore, and we managed to do about $300 million worth of deals with that capital partner, which got us going. And then we just built from there. So the business has continued to grow every year since.
The market back then, you would say, would be quite different to what it is today. Like you see, there's a greater role in this sort of non-banking sector. It's a huge market now, and back then it was probably in its infancy. Is that fair to say?
Yeah, it was interesting. The GFC really cleaned the non-bank sector out. So our data is that the non-bank sector was about 25 billion, which is around 10% of the capital market, which is actually interestingly more or less what it is today, that 10% number. But when the government guaranteed the deposits with the banks, when the GFC hit, there was a run on all the non-bank capital, which were primarily structured as sort of debenture type models. I'm sure you obviously were in the industry when that all happened, and so as a consequence of that, it's kind of killed the non-bank sector. To be honest, the fact that the government guaranteed the bank deposits, and everyone said, well, it's all going to hell in a basket now, and the best thing we can do is to put our money in the bank. And so they withdrew or tried to withdraw funds from the non-bank sector, and of course that created a liquidity issue, and as a consequence there was stop redemptions, and that was the end of the non-bank sector. Interestingly, at that juncture, and I'm sure we'll talk about this later on, the non-bank sector pre-GFC was only in the investment space, so there was no non-bank capital that was actively involved in the construction markets.
Right.
So it quickly went from 25 billion to zero, and it started then coming back Early 2010, 2011, really out of Melbourne. The family offices out of Melbourne drove the resurgence of the non-bank sector, the private, I guess, credit markets. And a lot of the houses that are currently active and in fact now listed, were born out of that. Were born out of that period of time.
Yeah,
Qualitas, for example, is an example. So yeah, what was a difficult time was a very difficult time, but at the same time, it was probably the best time to start the business, right? Because clean slate.
There's only one way up.
Only one way. Well,
when you started from zero.
Yeah, well, that or failure, right? So
yeah, that's right. But moving on to the current business, Stamford Capital, it's become a pretty large operation. It's sort of got offices all around Australia. You've got a large number of staff. You've gone from yourself and Michael back then to now 40, 50 staff, maybe more. Yeah. Tell us a bit about the current operations and what the focus is.
Yeah, sure. So the principal business is still the broking business. So last year we settled $2.2 billion of deals. It's all in commercial real estate, so we don't do home loans or equipment finance. We're very narrow, I guess, in our product offering. It's all about real estate and commercial real estate, and that includes development, residential development. When I say commercial, we include that in that bucket. Our pipeline this morning is about 4.5 billion, so we're continuing to grow out opportunity, and I think the market's still presenting us with opportunity. As you say, we've got offices Sydney, Melbourne, Brisbane, Adelaide, and as a consequence of COVID, we've now got people in Bowral, Gold Coast, Byron, Kingscliff, wherever, and we certainly moved to that sort of work from anywhere strategy pretty quickly through COVID. But the business is very active. We see a lot, we speak a lot to customers. We're certainly at the coalface in terms of what's happening with credit and capital more broadly in and around real estate. Last 2 years, we've transacted with 80 capital partners. So, we know where capital's willing to trade at, and I think we're pretty uniquely placed, frankly, to be able to, offer an opinion and a meaningful opinion as to what's happening in the credit markets in particular. On top of that, we've grown the business. So whilst the brokerage side of the business is still the core and the heart of the business, we hold a wholesale Australian financial services license. We've invested about $600 million of our investors' money, including our own, into transactional opportunities. That tends to be up the risk curve a little bit, so mezzanine debt, equity, joint venture type capital, so that we operate the brokerage business in a very pure sense. It's all credit.
Yep.
And anything that's falling outside of that, that's up the risk curve. We're happy to provide our balance sheet to execute those deals. Our current fund, Core Partners Fund number 2 is what it's called, has commitments about 50 million, but it's really a balance sheet. It allows us to take a position in a deal, underwrite that transaction, and then go back to our investors and sell that risk down. So whilst it's a $50 million fund, we could do $250 million worth of deals with that balance sheet. And then separately, and I guess somewhat relevant to this discussion, I guess, is we own a 50% share in a property development business that develops fast food and fuel assets. Think McDonald's, Guzman y Gomez, Hungry Jack's, KFC, et cetera. That's a pretty active business. It's probably got a couple $100 million in pipeline. So we wear our developer hats in that business.
I think that's a great investment because I'm a regular consumer of fast food. So.
Well, that's good to hear, mate.
Yeah, that's good. But look, I mean, the markets, you look at the last 10 years, and we'll get to the current in a second, but let's look at it up until pre-COVID, for example. And would you have seen an evolution or a change in the customer base, maybe in the number of capital partners that were out there that you could work with? How did it evolve over that sort of, let's call it the 9 year period?
Yeah. Yes. It's definitely changed, and if I go back to the immediate period post GFC, where the capital that was active outside the banking sector wasn't really organised, I guess. But it was opportunistic, it was smart, it was obviously able to invest and generate, great risk-adjusted returns. And then what happened was, businesses were established around the opportunity set to service that, in particular the construction market. And again, there was no non-bank capital credit that was active pre-GFC. That whole construction non-bank capital was driven post-GFC. And so we're yet to really, we haven't gone through a down cycle yet, not of any meaningful consequence. And so yet to see how that plays out. I'm happy to talk about that later on. But it definitely has evolved. It's got way more sophisticated. The parties that are active in that market are developing their own brands. We as a business tend to operate in the, our average deal size about $11 million. So we sort of trade in that $2 to $50 million space. That's where we're very active. And most of the capital that's active in that market generally needs a third-party distribution business associated with it to find its deals. It just doesn't have the bandwidth to be able to hire a sales force, I suppose.
To do it themselves.
Yeah. Whereas at the larger end of the market, let's say $50 million plus, most of those businesses are actively targeting clients directly, so not necessarily using third-party distribution businesses like ourselves to find those customers and to build relationships with those customers. But it's far more active. Again, it's grown from what was essentially zero through to, we estimate, around a $40 billion market. So again, it's around 10% of the active capital market. And we still think it's got a long way to go if you benchmark the Australian market against, say, the US or the UK. Those markets range 40 to 50% in terms of...
Yeah, it's a lot more diverse over in those markets, is it? Like the major banks just don't have the kind of control that, or market dominance that seem to exist here.
Yeah, and listen, the big four have always dominated the real estate sector, as they tend to dominate, I guess, the more the broader economy in terms of credit. That is changing, and I think it's changing in particular if you think about there's a lot of pressure coming onto the banks directly from APRA to ensure that they're managing risk properly, and construction has never been one of those risk elements that APRA has been super favourable of. And even where the banks are comfortable underwriting that risk, it tends to be very late in the development cycle where, for instance, a significant level of pre-sales has been achieved. What the non-bank market has been able to do is to evolve to a point where it's filling gaps, I guess, where the banks aren't able to play.
Yeah.
And not just aren't willing to play, aren't able to play because of policy and or restrictions which APRA is putting on them in terms of how they operate. And that's not changing. I can't see that going back the other way. And so we're a firm believer that the non-bank market is here to stay. And not only that, we'll continue to grow and continue to penetrate the market. I think the other thing that's worthwhile noting in terms of talking about that journey over the last 10 years is, if you spoke to clients 10 years ago about the non-bank market, any client that was that viewed themselves as sort of mature and knowledgeable would view the non-bank market as a market they just didn't want to participate in.
Yeah, that's right.
It was like, why would I go there? I'll just deal with the banks.
Yeah.
And I think what's happened the last 10 years is those clients have been educated that it's an alternative to the banking market. It's not a negative, and I think that education process has definitely happened.
I experienced a little bit of that probably 5 or 6 years ago, where my network is primarily accountants and lawyers, and I found with the accountants and lawyers that the level of willingness 5 or 6 years ago or knowledge was quite low. It was they the good ones were always on top of it, but talk to them about this non-bank sector, the availability of capital outside the big four. You'd always hear the common story, the bank's not lending everything, and then you go, well, have you thought about this other sector? And of course, no, I don't go there. You're going to charge massive rates, but that's actually not the case. I mean, there are expensive lenders, and of course, but as more competition has come in, it's become much more competitive. And so, as that 5 or 6 years ago, today, you have the conversations with the same people, and they're commonly talking about their clients using different types of lenders. I think it is definitely a sector that people are more comfortable with and understand it more. And whilst in hindsight you might go, well, it shouldn't be that difficult. It's a comfort factor, I think, that gets people across the line. Yeah,
I think it's still relatively new. Coming out of the GFC.
Yep.
And I think as a consequence of and also what's happened is there's been a bit of a drain of human capital out of the banking sector into the non-banking sector. And a lot of those people who've moved out of the banking sector into the non-banking sector are very, been through cycles, they've been through different markets, they understand the asset classes, they know what they're doing in terms of underwriting transactional opportunities and building a business, in fact, in and around the opportunity set that presents there. So it's evolved. It's far more sophisticated than it was pre-GFC, in my view. I think it continues to grow into the future. I think it'll be interesting to see when we do move into a cycle that's perhaps a little bit more challenging, how the non-bank sector reacts, because certainly the banking market has been pretty patient. That's been my observation. Interested in your comments there, obviously, but I suspect the non-bank sector won't be as patient, perhaps, as what the main.
Look, it's a difficult one. I mean, the enforcement in the non-bank sector is quite difficult to monitor because there's so many different ways of enforcement to. Just a mortgagee in possession is not something that can be done by a lawyer. It can be done directly with an agent. So generally speaking, we're not seeing too much of an uptick yet. My feeling, there's been a pickup, don't get me wrong, but there's been a pickup just generally in insolvency. But I think early next year's going to be an interesting year. If we continue to see interest rate rises, and I want to get to that soon, which I think there will be more, we're going to see some correction there. The level of correction, I think, is going to be what will be interesting. But look, let's move on to, let's call it post-COVID. I mean, I don't know whether talking about COVID is really the period there, because it was just completely unpredictable. But now we're coming out of it. Now everything's gone back. The legal restrictions, the government grants, all that stuff's being removed, and we're back to a normal type of operating economy. But we've got the hangover of COVID, and now we've got huge inflation issues around the world. So, what do you see that impacting your space over the next sort of 12 months?
It's if I can take us back, I guess, to when COVID initially hit, because my comments will be influenced a little bit by that. So COVID hit February, March 2020, and liquidity stopped. And we hadn't seen liquidity stop since the onset of the GFC. And certainly in our space, and I guess more broadly, pricing is an issue. Liquidity is more important. Because if liquidity stops, then we head into a GFC type outcome. And so between April, May 2020, liquidity definitely stopped. I mean, we had hundreds of millions of dollars of deals pulled that were in the pipeline getting towards approval and supported, et cetera, from the lenders, pulled overnight as everyone just pulled right back, and that was a bit scary, I got to say, just to deal with that immediacy of a potential correction. And so we always monitor liquidity, and I think that's a critical thing. Certainly in the real estate sector, it's such a big user of capital that any hiccup to liquidity can be disastrous. Fortunately, as you know, capital poured back in through federal government assistance and all the other initiatives that were not only undertaken here but globally to deal with COVID. And so it was very interesting between March and I guess the end of May, early June. Everything stopped, and then from June onwards, it was just like let's go. And like, it was just extraordinary how quickly it went from business as usual to what the hell is going on here. Deals getting pulled left, right, and centre. To the green light turning on again.
Just acceleration.
I mean, I've never seen it in my entire career.
Yeah, wow.
Not the pace at which it went from business as usual to stop to green light. It was not within the course of 3 months, right? And really post that June 2020 period, I mean, we doubled our volumes year on year that year. And so there's certainly appetite in market to continue to do deals, and this is obviously leading into the current inflationary environment which we now find ourselves in. I mean, it was somewhat inevitable in my mind that inflation had to come. We can't be printing money like governments have been doing globally over the past 2 or 3 years and not pay the price, right? I mean, I think that the thing that's worrying or most concerning for us, I don't want to use the word worrying, is just how far the inflation numbers go, because the banks have gotten it wrong, the RBA's gotten it wrong. I've got no faith in in the professional commentators, and so we're cautious. As a consequence, we do think inflation. Look, it's moved so quickly globally. It's so quickly in Australia. And it's had pretty material impacts on obviously the construction sector in particular, in the space that we obviously operate in. And we've probably really yet to see the fallout or the potential fallout that comes from inflation and rising interest rates, in the commercial markets outside of the construction markets. If you think about what it means for valuations of commercial assets, for instance, I mean, they're still holding up. They're still trading largely quite strongly off the back of the liquidity story, in my view. There's still plenty of money in markets, both in the sort of private markets and the institutional markets. If there's a chink in liquidity, if we get a bit of a tightening in liquidity, and there was some press last night out of the US about liquidity tightening, so we're certainly really watching that quite closely. If you get that coupled with inflation and then the interest rate environment we find ourselves in, then things can turn pretty ugly pretty quickly, unfortunately.
Yeah, I mean, there seems to be an over level of interest in the construction space by the media, which and they're linked to high levels of insolvency, and which I think, there has been a pickup, but not all that different to all the other industries. We have an energy crisis going on, for example. We have issues at hospitality. Retail is probably holding up pretty good at this stage, but you do wonder 3 or 4 more interest rate rises. That's got to be the next part of the personal budget that gets cut. So, your thoughts on the construction space? I don't agree with the media saying that there's a significant uptick in insolvency for construction. Yes, absolutely. There's people falling over, but is it a combination of a catch up of maybe some of these probably should have gone anyway during COVID?
Definitely. And
certainly there is a reduction in profits in construction, but there's a reduction in probably most industry sectors too. But what are your thoughts on that?
Yeah, there's definitely an element of catch up. So the data that I've seen is that the average number of building companies that go into administration every year or every quarter, is about 500 a quarter nationally, during COVID, that was as low as 200 a quarter, just given the support that those companies received from JobKeeper, sorry. And so there's no doubt there's a bit of catch-up happening of companies that otherwise should have gone into insolvency over the last couple of years but have been protected as a consequence of, the support.
The tax office didn't do any recovery proceedings either. So
That's
for
right.
those that there were the companies that in normal circumstances would have had enforcement put on them, those companies survived and then put their hand out for the JobKeeper and then continued to be racking up losses it's management skill where I believe most of the failure occurs, not really anything else.
Yes.
So it is a catch-up. I don't think we're in a correction yet in insolvency. I think we're in a catch-up. But certainly the construction seems to be getting a lot of attention.
It
in
is.
my view, a little bit unfairly. But,
I think that's probably a fair comment. I mean, it's when you've got high-profile home builders, where those home builders have 8,000 dwellings on their books, it has a material impact and is newsworthy, right? I mean, I think that's a fair comment. Thinking of Metricon, for example, as the it hasn't obviously gone into administration, but it certainly has had to deal with some issues.
It had a lot of attention, that's for sure.
It's definitely had a lot of attention. But it's been recapitalised, and to your point. But I also think that there has been no doubt significant cost escalations, and the problem with the construction industry is it just operates on such wafer thin margins. You don't need much of a correction for these businesses to get wiped out. And look, the finance industry is guilty of driving that structural issue, in my view. 20 years ago, you didn't need you could finance a project without necessarily having a fixed price contract in place with the builder, whereas the credit departments in the banks realised, hang on, we can pass all of that price escalation risk on to a third-party builder such that our developer client and we're not bearing that risk. They drove that outcome, right?
Yeah.
And so the financiers have a role to play in dealing with the current environment that we're in, and I think they're starting to recognise the fact that perhaps they've pushed things a little bit too far. I mean, even pre-sales. I mean, the notion that projects needed pre-sales to be funded is only something that's been in existence the last 20 years, really.
Yeah,
30 years ago, the notion of getting a pre-sale before you built a residential project, what are you talking about? It didn't exist.
Didn't make sense.
And so the markets evolve, they continue to evolve. I think the financiers have probably created, it's not solely their responsibility, but they've certainly participated in creating a structural issue that exists within the construction sector that is now being talked about in quite a number of different circles.
What's your personal, or what's Stamford's view on where you think the market is and where it's heading in the next, say, 12 months? What's your thoughts?
I think we start to see, and I was just speaking with a builder on this particular issue yesterday. So his perspective was that they're starting to see a sort of normalisation of the cost escalations. So we're not experiencing 10, 15% annual increases. I think that starts to stabilise.
Yep.
Perhaps as supply lines start opening up again, even starts to come off a little bit. Interestingly, the builder that I was speaking to, his observation was, so the material side of things seems to be stabilising. He's certainly not expecting, and this is our view as well, we're not expecting to see anywhere near the same escalation that we've seen over the last couple of years in supply, in costs, but the wages story is yet to play out. And so, the unemployment rate at the moment, 3.6%. We've got no foreign labour in the country, and I know we're trying to rectify that. There was that job summit obviously last week to try and bring some skilled labour into the country, but that's going to take time, right? That doesn't happen overnight, and so we do think we're going to start seeing escalation in labour costs. And whilst we see this normalisation in supply of products, steel, framework, timber, etc., we do think we're probably going to see some upward pressure in wages. And as a consequence, that's probably going to continue to feed through putting some pressure on builders. So we'll see.
It needs to almost be passed on to the developer in a way. That the developer's just going to have to stand up and accept there's less profits in what they've been experiencing, certainly in recent years.
And the developers have had a pretty good run. Like they'll complain, but the reality is they've made some really good money over the last 2 or 3 years, with capital being as free as it's been. And I say free deliberately because it's been free in an availability sense, but it's been very cheap, right? I mean, we're at historic lows in terms of what capital costs, and I'm not just talking credit, I'm talking equity. That is changing, and happy to talk through that in a little bit more detail. But the contractors also have been in the process of renegotiating contracts with developers as a consequence of this cost escalation, and so the margins which those developers have experienced are probably compressing a little bit. I think that's a fair comment, but it will reset. I mean, the reality is, once we get some stabilisation in terms of what the inflationary numbers are doing, and we've got some clear visibility as to where interest rates are going, and there's some stabilisation around costs from a construction perspective, land values will reset, which is the big that's the big lever, right? The reality is, once all those numbers are known, land values reset and development cycle will start again. And we're sort of reasonably, whilst we are concerned about markets, we do think from next year onwards things start opening up again, because we do think by the end of this year there's going to be a little bit more clarity around, calendar year I'm talking, a little bit more clarity around inflation and interest rates in the Australian context. Yeah, well, it's a bit hard to know at this stage when things are going to slow down, because certainly other countries continue to have much higher inflation than we do, and we're also, as an economy, really benefiting off the energy crisis at the moment. Huge current account surpluses, record numbers. We benefit from what is happening over in Europe with the Ukrainian conflict. Is there any sort of thoughts around the energy market playing having an adverse impact in the market for construction? I can see, to put some sense around that, I can see the supply chain and the cost of materials and the wage. That's the key cost. But this sort of uncertainty in the energy market at the moment, you see that playing a big role in the construction space? Only to the extent that it impacts on cost of materials. Energy on site to build a project. It's a number, but it's not material in the context of a construction project. It's really the inputs, the cost of supply, cost of goods that go into manufacture of that project itself. And look, there's no doubt, to the extent that energy continues, at the rates that it's been increasing, that has to feed through into the cost of steel, the cost of timber, the cost of machinery around machining the timber, etc., the cost of transport, frankly. But again, I think that's being offset to some extent just by supply lines normalising.
Let's pivot for a little bit now and just talk about the insolvency market, and how that may impact the construction finance space. So what I mean by that is, as we see corrections or a pickup in insolvency, the risk criteria for lending becomes stricter and tighter, and new things come into play. Like the one that most commonly comes into our space when we're talking to directors is this, by me putting a company into liquidation or administration, is this going to impact my ability to get refinance? And the reality is, over 25 years, I think I've had 5 people that have been impacted. It doesn't really do much in terms of it being a serious part of the decision-making process to lend. Do you feel that the risk and serviceability criteria or whatever other criteria that the lenders have, will that change much, given the current economic conditions?
Well, it's changing.
Yeah.
Yeah, it is changing already. So, I commented earlier around the freeness of capital. We're definitely seeing both in the banking sector and the non-banking sector tightening of credit, and by that I mean just the terms with which those lenders are willing to underwrite the deal, whether that means more risk mitigants being in place, so a higher level of pre-sales or a higher level of leasing pre-commitment, or more certainty around construction costs, etc. But I guess the easiest way that the banks and the financiers deal with a changing credit environment is to delever. So we're definitely seeing both in the banking sector and the non-banking sector a deleveraging occurring, and that's not just in construction. We're also seeing that in the investment market. I mean, when rates are at essentially zero and investment debt's being priced at, say, 2%, the cost of servicing that debt's easily achieved in the investment markets. When the cash rate's at 2.35, maybe 3, and you're applying the same margin, all of a sudden the cost of servicing that debt becomes significantly higher. And so, interestingly, what the banks did around the interest cover ratio, which is effectively income divided by the cost of servicing the debt. When we moved into this very low interest rate environment, they actually increased the interest cover ratio requirement from sort of 1.5 as a benchmark to 2. So you needed to have double the amount of income effectively relative to your interest cost. As we've moved into this rising interest rate environment, the banks are actually starting to bring that number down, which means that they're able to get deals done. Right?
Interesting.
Yeah.
Interesting.
You'd expect them to go the other way. Like the natural reaction is, hang on, rates are going up. But it was always 1.5, historically. And so what the banks did, which I thought was quite clever, they realised we were moving into this extraordinary interest rate environment that was unlikely to remain the case for the long term, ratcheted up the ICR cover, now are in the position where they realise when interest rates are somewhat normalising, wherever they end up at, and they're testing at 1.5 times, but they are testing at 1.5 times on a forward-looking basis. So if the chief economist's view in the particular bank we're dealing with is that interest rates are capping out at 4%, they'll test at 4% plus the margin in terms of that serviceability ratio. They're not running it off today's numbers, which again is putting a little bit more pressure on borrowers in terms of their capacity to be able to refinance existing assets, but also in terms of their ability to be able to acquire new assets. Obviously, getting credit is fundamental in terms of refinance and or acquisition. On the construction side of things, again, we've seen both the banks and the non-banks delever. So where I guess the non-banks were capping out at, say, 75% loan-to-value ratio, to put that in context, the banks are really at 60 to 65 as a benchmark. We've seen the non-banks come down, so they're largely at around 70 now. For an extraordinary deal, an extraordinary sponsor, maybe you get that stretch up to 75, but the reality is they're deleveraging because they're recognising that they're moving into a heightened risk environment.
More uncertain.
Yeah. And to the extent that the non-banks, there was a a large number of non-bank lenders that were willing to underwrite residential development without any pre-sales, they're now starting to say, oh, hang on, we might want to have a small number of pre-sales, even if it's 10, 20%, just to demonstrate that the product's acceptable by market. And so they're not only deleveraging, but they're ensuring that their risk profile is more, I guess, suitable given the environment that we're in.
The conversation has definitely changed, but it's not as severe as what we might think. It's they're moving up the risk curve, I suppose, a little bit, or going back to the previous risk curve that was there. Let's finish off with a prediction. And you're allowed to get this wrong, but like January 2024.
The RBA gets it wrong. All the chief economists get it wrong.
You did say that at the beginning. Yeah, that's right. You did actually say that. And so let's just create our own economic predictions. But let's sort of fast forward to June 2024. What do you reckon the market's looking like then?
It will depend on what happens with rates and inflation. I think there's my economist carve out for you. But my view is that interest rates, the cash rate, caps out at 3 to 4% in that range. I don't see that as a disastrous outcome. I think that price can get absorbed into markets. Look, some people are going to hurt, and it's the unfortunate reality of the interest rate rises. It's a pretty blunt instrument, and it tends to hurt those that can least afford it, unfortunately. So there will be some pain. There's no denying that fact. But rates cap out at 3 to 4%. I think markets will adjust in a fairly orderly fashion. I'm not expecting to see, an absolute bloodbath. If rates get into the fives, I think that situation can change pretty dramatically. And as I touched on earlier, I guess more importantly is what's happening in liquidity. And, both, I guess in the Australian context and in the global context, all governments are deleveraging. And so that needs to be managed very, very carefully, in my view, to the extent that they get the timing wrong.
Yeah.
And or delever too quickly, which results in a liquidity crisis, as we had during the GFC. Yeah, look, that can obviously have a material impact on markets, as I touched on earlier. So, on the assumption rates are at 3 to 4%, we aren't in a liquidity issue. I'm actually reasonably bullish about next year. I think, if we talk about markets, and I break the construction market down into the residential market, which is about half of our book at least. We've had no supply in the apartment market really for 2 to 3 years.
Yeah.
The feds open up markets to immigration and to students returning into this country. There's pent-up demand. I think we're actually fairly bullish that we see a cycle coming in the apartment market that's going to need capital, and we're positioning the business to take advantage of that.
Yeah, it certainly felt like there was a catch-up happening 2 or 3 years ago, and we're getting to the point of, are we getting close to an oversupply? But I don't think, we certainly didn't see the oversupply issues that the Gold Coast had in the GFC. That never really hit Melbourne or Sydney at any, or even Brisbane in a serious way. And now I definitely feel like that, we've gone back into, there's a big shortfall of and that pent up demand, like you say, that just needs to be dealt with.
Yeah,
which means that you should be fairly confident in the space, in that sector, that things are going to, once things can normalise in those costs and wages and space like that, and the inflation, then you should be more confident than what potentially you read in the papers.
Yeah, and we genuinely believe that. That's certainly the house view, I suppose, for the moment. And again, I think that I don't know if it was PCA or one of the agents came out, and there's 7,000 apartments being delivered this year, which is
tiny.
Oh, it's nothing.
Yeah.
And I think the other thing that's worthwhile pointing out is, the gap between average house price, average apartment price is at historic high. And rents in, say, Victoria, for example, rents are up 30% year on year. And so the yield story around investing in apartment stock starts playing out and probably sees the return of investors into a market where they've been vacant, haven't been active for years, both domestic and foreign. I'm not suggesting necessarily that we see, the return of foreign investment like we saw, I guess, early or over the last decade with the mainland Chinese market. But I think we certainly start seeing more supply coming. I don't necessarily mean that we're going to see price increases. I think things probably, if they do go up, will go up very slowly and not by a significant amount. But I do think the correction that we're seeing in house prices at the moment is largely in the housing sector. It's not in the apartment sector. And, coming back to costs, you get to a point where replacement costs become relevant. I mean, the reality is if costs have genuinely gone up 30% over the last couple of years, and that's a real number, then apartments, the cost of replacing apartment becomes a relevant number. And so that will put a floor under pricing in the apartment sector, in my view. So I certainly think we see supply coming. That's a discussion that we've had, and we've had with a number of our lenders, and they seem to be on that same they're of that same belief. In terms of construction in the commercial sector sense, look, it really depends. That sector depends on who the tenant is and the strength of the tenant or tenancy profile. If it's a multi-tenanted building, provided those tenants continue to trade well, capital will be found for those opportunities. On the investment side of things, look, we haven't seen any correction at all in the commercial markets, not really. I think it's coming. I think you can't have debt trading at, say, 350 cash rate, 550 borrowing costs, and assets trading on 4% yields. That just does not make sense to me.
No.
And so we think yields soften. Again, provided liquidity's there's a lot of money in market, both in the private sector and the institutional sector. I think that, again, puts a bit of a floor on those asset values. At some point, someone's going to buy them. And so as provided liquidity remains, I think yields soften, but we don't see, a calamitous outcome.
Yeah. So you're now the chief economist for Stamford Capital, is that right?
I'll put that hat on as well, mate.
Anyway, we better wrap things up. But thank you, Domenic. It was great. And look, Stamford Capital, obviously the leading player in their space, and they are very close and somewhat have a more accurate view, in my perspective, my opinion, around the construction industry and the construction finance. But thanks again, Domenic. It was great. And thank you, everyone, and we'll see you next month.